isn't it true that now when investors think about mutual funds, they only think of the long term? But what a lot of people seem to forget is that the largest category within mutual funds is the liquid fund category. So these are kind of debt funds which actually invest only in very short-term securities, and therefore investing and redemption becomes very, very quick, easy and fast. And unlike the assumption that these are used only by corporates or they're useful only for corporates, retail investors too can find many, many benefits.
Couldn't agree more, Sumaira, because in every one of our lives, liquid funds will have relevance at a point in time. For example, if you have money to be paid to a builder when you've bought a house and you have still 20 more days to pay him, you can park that in a liquid fund for that interim period and effectively utilize that money. Second, most of us actually keep a contingency fund when it comes to personal finance to make sure that if there are surprises which life have in store for you, that contingency fund is best parked in a liquid fund.
The other good thing is that these funds naturally don't have any lock-in and also don't charge any exit load. But besides this, Feroze, anything else that retail investors need to keep in mind when they're choosing liquid funds as their investment vehicles?
Especially retail investors don't fall in the highest tax bracket because their incomes don't supersede 10 lakh rupees. So choosing a growth option is a better alternative because you will not get into the long-term category unless you hold the liquid fund for 3 years, which is anyways not going to be the case.
One apprehension that retail investors may have is that since the largest investors in liquid funds are corporates, therefore at times like say when they have to pay advance tax, suddenly we see a big outflow that happens from these funds and therefore some fair bit of volatility. Is that still advisable then for retail investors?
Yes, see, volatility can be of different magnitudes. Of course, like you rightly mentioned, Sumaira, corporates come in and go out in large quantums. If that's going to be influencing my money as a retail investor, I would like to keep away. But fortunately, if you do the analysis of liquid funds, the worst volatility will not make you return for 4 days or 5 days. In bad situations, liquid funds might end up not making you money for a week. And I think that's a very acceptable volatility, that too in extreme situations.
But Feroze, how do the returns stack up?
Now that we've understood the liquidity and the risk, return fortunately has been in the range of 1.5–2% greater than a savings bank account, which I think is a comparable instrument.
All right, so the returns are better, but can the costs match up?
When it comes to cost, liquid funds are the cheapest mutual funds.
All right, so they may be liquid, but they are pretty solid. I know a lot of people like bank fixed deposits, right? But I've often been wondering what's a good alternative, to give to people who like bank FDs. Is a fixed maturity plan the right fit in that sense?
You're absolutely right, Sumaira. I think we as Indians love our fixed deposits, and FMPs are certainly a good alternative for a fixed deposit investor.